Oliver Persh, why do I want to own high dividend stocks in 2012 when people expect the economy to grow? Why not growth stocks?
Well, no one's saying that you shouldn't own growth stocks, Greg. The point is that dividend is a key component to total return. So investing in high quality, high dividend paying stocks that also have growth characteristics should do very, very well for your portfolio in 2012, just like it did in 2011.
Well, one stock that had a lot of growth in 2011 was McDonald's. Stock really took off and really carried the Dow. Why do I want to own it again in 2012?
Well, number one, the yield is still attractive, but most importantly, from a growth perspective, McDonald's continues to grow internationally. They're ramping up revenues, they're ramping up same-store sales, they're doing everything that a growth business should do. So again, here you have a great example of a company that's exhibiting all the characteristics of a strong growth stocks, but has high yield and a strong balance sheet to support it. So it gives you a little bit of a buffer in these relatively uncertain times economically. After all, Europe hasn't exactly solved all its problems yet.
You also like Intel, and you like it for its yield and its growth, which is surprising for a tech company.
Sure. So Intel is one of those unsung heroes of the high yield world. It had a yield well over 4% for a little while. The stock has rallied. But again, here's an industry in terms of technology and a company specifically that's best of breed. We have a very strong balance sheet, high credit quality, good growth prospects, and an attractive yield around 3% that is giving you the best of both worlds.
You also like Royal Dutch Shell. Why is this the best player for you in the energy patch?
So in the energy patch, we like Royal Dutch Shell for a couple of reasons. Number one, we do think it's a very strong company. And in fact, when you look at its balance sheet and its business model, it's not much different than our very own ExxonMobil. However, as a result of being based out in Europe, it has gotten beaten up a little bit more. So you're getting an extra third to a half a percentage point in yield right now. And you should take advantage of that as an investor.
Now, you also like Abbott Labs. Healthcare stocks had a great second half of 2011. Can they carry it over to 2012?
We certainly think so. Now, as always, you need to be specific and you need to do your fundamental analysis. But when you look at Abbott Labs that has growth prospects of revenue growth over 10% for year over year for the next 3 years, you have a strong dividend and you have a fundamentally good pipeline as well with nothing in terms of major drugs of theirs expiring or coming off patent. We think it's a best of breed and should do pretty well in 2012 as well. Again, keep in mind, dividend yield is a big component of your total return, so that's part of the reason why we like it.
And then finally, you launched something last year called Dividend Busters, which is a takeoff on the dogs of the Dow. How did that do in 2011?
We're up over 17% net of all fees in 2011, so we beat both the Dow Jones Industrial Average as well as the traditional dogs of the Dow strategy, and that's done very well for us. One of the key components about this and its success is we relaunch a new series of the portfolio every quarter. So we take into account economic developments and company-specific news. So the portfolio does shift every quarter. We do monitor all of the securities, and it's not just a set it and forget it type of strategy, which we are not a big fan of.